Welcome to the video. Today we'll tackle a common financial crossroads. When you graduate with both student loans and investments, should you sell your assets to pay off your debt? Or keep investing while paying loans down over time? We'll analyze this decision through the lenses of guaranteed returns from interest savings, tax consequences of selling investments, portfolio simplification, and the power of income and budgeting. We will walk step by step, use diagrams, evaluate scenarios, include quizzes, and end with a concise plan you can adapt. Let's begin. Here is the agenda. We will begin with the big idea that loan interest savings function as a guaranteed return. Next, we'll cover the interest rate imperative and why the avalanche method usually wins. Then, we'll navigate the tax pitfalls of selling investments. After that, we'll show how to leverage income and budgeting to eliminate debt quickly without liquidating. We will also clean up the investment strategy. We'll use step-by-step instructions and diagrams, include quick quizzes, and finish with key takeaways and a clear action plan. Disclaimer: this content is educational and general in nature. It is not financial, tax, or legal advice. Your situation is unique, and you should consult qualified professionals before taking action. Here is the big idea. Paying off high-interest debt creates a guaranteed return equal to the interest rate you are avoiding. For example, paying off a loan at 6.28% produces a risk-free, tax-free equivalent return of 6.28%. While markets may deliver higher returns over time, they are uncertain and volatile. Eliminating debt is certain and also reduces stress and frees up cash flow. That certainty is often more valuable than chasing marginal market gains. Let's talk interest rates. If your loans are at 6.28% and 5.25%, these are prime candidates for payoff priority. The avalanche method means you make minimum payments on all loans, then direct extra dollars to the highest interest rate balance first, moving down the list as each is paid off. Do not confuse hypothetical market returns with guaranteed savings. The 6.28% you avoid paying is a sure and tax-free equivalent return, which leads to lower risk and more predictable outcomes. Additionally, the psychological benefits and relief of removing high-cost debt can meaningfully improve your day-to-day life. This flowchart maps the decision process. First, determine whether you have an emergency fund. If not, build 3 to 6 months of essential expenses in cash. Then check for an employer 401k match and contribute enough to capture the full match because it is an immediate return. Next, review loan interest rates. If any loan is at or above 6%, use the avalanche method to aggressively pay it down. If rates are between 4 and 6%, compare the benefits of paying down with cash flow to the tax costs of selling investments. Typically, avoid selling if it triggers short-term capital gains taxes. If all loans are below 4%, maintain investing while paying minimums. Reassess quarterly and automate payments to stay consistent. Now the tax angle. If you sell investments held for less than 1 year, your gains are taxed at your ordinary income rate, which can be significantly higher than long-term capital gains. This tax drag reduces the net cash available to pay off your loans, weakening the benefit of liquidating. Consequently, if you have strong income, it is often better to keep your investments, avoid triggering short-term gains, and instead use your monthly cash flow to attack the highest interest loans. In some cases, waiting until holdings reach long-term status or using tax loss harvesting to offset gains can improve outcomes, but you must verify the rules and your own tax bracket. Let's leverage income. With an approximate $74,000 annual income and disciplined budgeting, it is realistic to eliminate around $19,000 in student debt within about 2 years without touching your investments. The priority stack is to build an adequate emergency fund, secure your employer 401k match, and then attack high-interest loans using the avalanche method. Automation of payments, calendar reminders, and budgeting tools help ensure you stay on track and accelerate progress as you find additional savings. Here is a practical plan. First, build a 3 to 6 month emergency fund to prevent setbacks. Second, contribute to capture your full employer 401k match because it is a high return benefit. Third, list every loan by interest rate and make the minimum payment on each while directing all additional dollars to the highest interest rate loan. Fourth, avoid selling investments that would incur short-term capital gains unless it is absolutely necessary. Fifth, simplify your investment portfolio by focusing on low-cost, diversified index funds held in tax-advantaged accounts where possible. Sixth, automate payments and check for autopay discounts that may slightly lower interest rates. Finally, reassess quarterly and aim to increase extra payments as your income grows or expenses decline. This pie chart illustrates a sample monthly budget allocation. Essentials such as housing, utilities, transportation, and groceries take 50%. Debt avalanche contributions consume 20% to aggressively reduce the highest interest loans. Investing receives 15% to keep long-term compounding active. 10% goes to building or maintaining the emergency fund. Finally, 5% is reserved for discretionary spending to make the plan sustainable. These percentages are examples and should be adjusted to your actual take-home pay and priorities. This illustrative table shows how focused monthly payments reduce a balance. With a $1,000 payment and approximate interest of around $100 in the first month, $900 goes to principal. As the balance falls, interest costs decline, and more of each payment targets principal, accelerating payoff. The numbers are simplified and rounded for illustration only. Use an amortization calculator for precise schedules based on your actual balances, rates, and payment dates. Let's compare methods. The avalanche method targets the highest interest rate first, which minimizes total interest paid and usually shortens total payoff time. It is mathematically optimal. The snowball method targets the smallest balance first, delivering quick psychological wins and momentum, but typically costs more in interest overall. If motivation is a concern, snowball can be useful. If minimizing cost is the priority, avalanche is superior. Now simplify investments. When you carry significant debt, it is prudent to reduce exposure to highly volatile assets such as concentrated individual stocks or cryptocurrencies. Instead, emphasize broad, low-cost index funds for core exposure. Use tax-advantaged accounts where possible to improve tax efficiency. Keep the structure simple, automate contributions, and rebalance on a planned schedule. This timeline maps a 2-year plan. Months 0 through 2 focus on building the emergency fund while immediately capturing the employer match. For months 2 to 18, the avalanche method targets the highest APR loan. At month 12, reassess your budget and increase extra payments if possible. From months 18 to 24, focus on the next loan. At month 24, celebrate reaching debt freedom and redirect the prior debt payment toward expanding your investments and other goals. Quiz time. Question: paying off a 6.28% student loan is equivalent to what kind of return? Options are: A. A risky 6.28% market return. B. A guaranteed, tax-free 6.28% return. C. A guaranteed, taxable 6.28% return. Or D. A 3% after-tax return. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Paying off a 6.28% loan locks in a guaranteed, tax-free equivalent return of 6.28% because you avoid paying that interest, with no market risk involved. Second quiz. Question: selling investments held for less than 1 year typically creates what kind of tax? Options are: A. Long-term capital gains tax. B. No tax if used for student loans. C. Short-term capital gains taxed at ordinary income rates. Or D. Only state tax applies. You may pause the video now to think about the answer. We will discuss the answer in the next section. The correct answer is C. Short-term capital gains are taxed at ordinary income rates, which can be high depending on your tax bracket, and this reduces the net amount available to pay down your loans. Key takeaways. First, paying off high-interest loans produces a guaranteed return. Second, avoid incurring short-term capital gains taxes when possible. Third, your income and budgeting discipline are the primary tools for fast debt reduction. Fourth, follow the priority order of building an emergency fund, capturing the employer match, and then using the avalanche method. Fifth, simplify your portfolio toward diversified, low-cost index funds. To summarize actionable next steps, list all loans by interest rate and automate avalanche payments starting today. Establish budget targets and, if feasible, Aim to direct 20% or more of take-home pay to debt reduction. Maintain your investment plan to keep compounding while avoiding unnecessary taxable liquidations. Reassess quarterly and celebrate each milestone to maintain motivation. Thank you for watching. If this video helped you clarify your debt versus investment decision, please like, share, and subscribe. Tell us in the comments how you plan to tackle your loans and what topics you want us to cover next.